morning call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning, thankfully, heading into the long weekend, the Christmas weekend. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi. Morning.
Hi, good morning. And all set for a very Merry Christmas. I'm all set with my, green top and my earrings, and I'm ready for the party. What about you guys?
I'm in red only because of Christmas, so it's part of the Christmas color. But I think, before we get into Christmas, I think this COVID scare has again told us that health is most important, right? So as we get into this best part of the year, I think health, just be thankful, to stay healthy. And I've been a little bit under the weather, so just happy to be a little bit better and looking forward to enjoying the coming week.
Okay, looking forward to enjoying the coming week and the long weekend, right? I mean, it's Christmas weekend, and it's good to see that there was a one-day shakeout on Wednesday, but then the market sort of bounced back to health. Yeah. So that's a good thing.
No, absolutely. And what a bounce back we've had, right? 1/3 of day before yesterday's cuts recouped in one single session. So I think we need to pick up from where we left off, that is yesterday's day. And it's been pretty good. I mean, all across, can't complain. You had the market which bounced very nicely, very, very strongly. And we finally ended and posted a positive daily close. So that's point number one, right? It would have been a bit of a bummer if the market after day before yesterday's 300-point day-to-day fall ended flattish or slightly lower, but there was a resurgence. Late rally in the Nifty Bank. Nifty Bank for most of the day was middling. It was not doing very much, but it picked up pace. Solid rally in mid-caps and small caps, both indices. I mean, actually, the 230 effect came into full force yesterday. The rally started across the board at about 215, 220 or so, but it showed through all the way in the last hour or so. And by the way, just one more thing. If you believe the leader is leader of this bull market is the PSU bank space, or the PSE space, that doesn't matter banks, but public sector enterprises, that came back very strongly with a 2% rally as well. Just one point, FIIs, I just looked at positioning. FIIs are now long, net long, almost 90,000 contracts in index futures. This is as of yesterday's close. It's just a question mark. Are we at one extreme now, right? The reason I'm asking that question is because in July, if you look at when the Nifty topped, FI long positioning had reached about 1 lakh crore. You can go back and you can find similarities between 90, 1 lakh crore, around there. The market starts to top out a little bit. So I think keep one eye on this particular number as we go forward. And by the way, at the same time, when you talk about FIs, client positioning is extremely negative. When I say client, I mean non-institutional. It largely comprises of HNIs. HNIs in retail, but largely HNIs, I would assume. So it's kind of divergent at this point in time. Now, just rewinding back to yesterday, U.S. markets had bounced. Again, U.S. market had sold off the day before yesterday. The same time yesterday, we were talking about how U.S. had sold off rapidly. But so there was a bounce, 1.25% of the S&P and the NASDAQ. The 10-year is up 4 basis points, 3.8, 3.9%, but under 4. The dollar index is below 102 levels. So this is all good, no problems. We had, by the way, U.S. jobless claims number which came through, which kind of showed that the economy is doing fine. It did not show any pickup in layoffs in corporate America, in the US. So this is, again, something, we've had so much pushback from the time that Fed Chair Powell said that rate cuts are coming into view. So many others, at least 5 Fed governors have come in and said, well, no, let's wait it out. It's not, maybe market is getting ahead of itself, et cetera, and maybe it's for good measure because, data over the last 2 or 3 days has been pretty good. All right, let's just circle back and round it off with levels here. We put this up yesterday as well. Resistance is the retracement. The retracement from day before yesterday's high to yesterday's low. That's 21,360 on the Nifty. We're not very far away. That's a 61.8% retracement of the fall. So that's the first level that the market needs to take off. And of course, then the recent high, which is 21,593. And yesterday's low of 20,976 becomes important to defend if the market starts to sell off a little bit. But now we've put some distance between yesterday's low and where we ended. And the Nifty Bank, for it, the 61.8% retracement, we put this level out at 230 yesterday. And because the last hour rally came through, the Bank Nifty closed above this level. That is the 61.8% retracement. And now for the Nifty Bank, it is the high that we saw, which is 48,219. So fingers crossed, but hopefully that day before yesterday's crack just was like a one-day wonder thing, and we are past it. It's a long weekend, and activity, etc., will keep thinning out as we approach the next week and the week after, etc. But GIFT Nifty is showing a decent 30-odd point uptick right to the word go. Sonia.
Absolutely. So, the big question, right, that we're asking, was the sell-off on Wednesday just a one-day shakeout? And if it was, then it's a good thing, because the bulls will then use this as an opportunity to buy into the market. We almost recovered 1/3 of what we lost on Wednesday. So, yeah, there was a big recovery in trade yesterday. The Nifty was back above the 21,200 mark, and just goes to show that this continues to be a buy on dips market through and through. A couple of spaces that I'm watching out for. PSU banks saw the dips getting bought yesterday. In fact, the Nifty PSE index gained over 1% yesterday, and this has clearly been the stock of the space to be in the last 6 months. So keep an eye out on that. The positive bias towards large caps is something that could continue. Remember, that's been the narrative so far, that be a little wary of mid caps, but large caps could continue to see buying action despite the volatility. The US markets were very strong overnight, no problems at all over there. The Dow was up 300 points. I'm also watching out now for commodities, both gold as well as silver. There's a lot of chatter on silver ETFs and how that's now gaining traction as an investment opportunity. And gold also gained overnight after, the data that came out from the US gave rise to expectations of Fed rate cuts in the month of March itself. So, that's perhaps the next thing to watch out for. Just a couple of things. We talk about the strong data in the US, but also keep in mind that some pockets of consumption are slowing down. For example, the Nike stock was down 10% yesterday. The company cut its sales outlook and came out with a $2 billion cost-cutting program. So all is not hunky-dory. You have to keep that in mind. There are definitely some risks on the horizon in terms of consumption and growth. But otherwise, this doesn't look like such a bad showing. And you know what? There's a long weekend coming up. So I don't think there's going to be any major directional trade being taken, but the uptrend is intact.
Well, Sonia, actually from a bullish perspective, yesterday was a better start than today, because yesterday you got that dip to get into. Yeah. And we had hinted out here that 20,950, if it holds out, then we could see a bit of a bounce. And that's precisely the way, it played out yesterday. So that was pretty good going as well. Now the bulls will be hoping for a non-core. A follow-through session is what they'll be looking forward to. Nifty range on the downside, 20,950. We bounced closer to those levels. We bound off those levels. And the recent high, 21,500, we have gone to those levels numerous times in the last 1 week or so, but we haven't been able to decisively conquer that. So that's why I'm looking at on the upside. Overnight cues, well, they're positive, with the dollar as well as crude prices quite weak. Well, yesterday we saw a bit of short covering as well that did play out, because both on the Nifty and the Nifty Bank, the open interest was low, and both those two indices ended well in the green. The FI as well, they covered more shorts than longs as well yesterday. So the short positions were covered to the tune of close to 7,500 contracts, which brings us to their net long positions. Now, the net long positions have hit 90,000 contracts. In percentage terms, it's at around 67%. The last time it was at 90,000 contracts was in July. When we hit that 90,000 contracts approximately, the Nifty level was around 19,980 approximately. From there, in the next 30 sessions or so, we corrected close to around 700 points till we became net short. And that's when the Nifty bottomed out. So the point I'm trying to make is, when the FIs go to extremes on either side, we have seen the markets either consolidate or change direction. So let's see how it plays out this time. But as we speak, FI long positioning is at around 90,000 contracts. Normally towards 100,000 odd is when you see a big swing, either on the short or the long side. Moving to the options data, the 21,000 put, well, that was fairly active in trade. 21,500 call as well was fairly active. And some will be hoping that maybe we see 22,000. So take a bit of a punt, go out there and buy the 22,000 call and hope that 7 rupees at most you lose. And if you make money, then in fact, you'll make a lot of money. But that's unlikely to happen, because volumes as well are likely to thin out. What's the range then? 20,950, 21,500 on the upside. And on the Nifty Bank, that's going to be crucial. Yesterday defended that 47,000 odd mark that we were talking about. So that becomes a border on the downside. But the 48,000 call, that has the highest open interest. The premium out there is around 400 rupees, but on average, it was around 250 rupees. So 48,250 becomes a bit of a resistance zone. GIFT Nifty suggesting some green to kickstart trade. We'll need to see some follow through from there. But Sonia, you're also talking about gold. And since you mentioned that, today's the last day with regard to the sovereign gold bond. And personally, I am hedging my position as well a little bit with regard, keeping my SIPs going for sure. There's no stopping out there. But I have applied out there as well. So some kind of allocation to gold may not be such a bad thing. And you're playing the weaker dollar as well. So that's my rationale. And for the next 8 years, I believe it'll give me decent returns.
Oh, absolutely. And it's a much, much better option than, a physical gold in terms of safety, etc., taxation as well. Sovereign gold bonds, great way to invest your money for the long term, of course. But on the equities front, let's take a look at what we should be doing this morning. We have some cues coming in. Chris Wood of Jefferies says that from a market standpoint, the Fed switch is clearly first and foremost the US dollar bearish and therefore positive for emerging market equities. It also, he adds, from a US and developed stock market standpoint, should be more bullish for cyclical equities relative to growth equities. He says, and despite the Treasury bond market's further rally following the Fed meeting, it is long-term bearish for the Treasury bonds, which Greed and Fear continues to believe are in a structural bear market.
Okay, well, so money market views now. This is in the rupee. Lakshmanan, a Federal Bank, says that following the 3-month high made by rupee earlier this week, it has declined since then, while most of its peers remain range-bound against the USD. The 10-year in the US, the yield and dollar index trading around 4-month lows as the silver lining for the rupee, and thus he expects the currency here to trade between 82.9 to 83.38 for the next few trading sessions.
All right, and on the bonds, Lakshmanan says domestic bonds rallied to 7.15%, which was last seen in September. Bonds are tracking lower inflation expectations and falling US Treasury rates. He expects the 10-year benchmark bond yield to trade in a range of 7.1 to 7.25% in the coming sessions.
Well, there are a lot of stocks to track for you in our special top 10 segment. We get to that in just a bit. We're looking at a few stocks, though, so let's run you through the list. We're looking at Siemens, All Cargo Logistics, we have All Cargo Gati, GMR Airports, WPIL, Ami Organics, LIC, Brigade, and RailTel. All of them will be reacting to positive news flow, while SBI Cards will be reacting to negative news flow.
Okay, well, Arvind Sanger is now joining us. He's managing partner at Geosphere Capital Management. Arvind, good morning. It's always a pleasure having you with us here. End of the year, and, markets have done so well here in India and, of course, out there in the US as well. Although it's been big tech in the US, the rally there has been broadening out, though. What's the prognosis, Arvind? We've had, and I was mentioning this earlier, Fed Chair Powell hinting at rate cuts. And since then, almost it seems orchestrated. Everybody else coming on and saying, well, maybe he not misspoke, but maybe the market read too much into it and rate cuts are coming, but not immediate, etc., etc. Just pushing back a little bit. What do you make of it?
Well, I think, clearly the financial conditions have gotten so loose so quickly that the Fed is a little nervous that maybe it'll reignite inflation or reignite growth. And what they want is they want the economy to slow down sufficiently that inflation, which is on a downward path, stays on that downward path. And they don't want, things to get too frothy. So I think they're trying to do that. But I think the market has made this bet right now, and this is a bet for the last few weeks, that inflation is in good shape and interest rates are going to start getting cut, March or maybe earliest or latest by the second quarter of next year. So I think all of that has been behind the rally, but you're seeing a little bit of a, momentum come out of the rally. I mean, we've come a long way quite fast, and we saw that in India a couple of days ago in a meaningful way. We've seen that in the US also a little bit at a similar time. But I think, at this point, we're going to need to see for a broad-based risk on trade to carry the markets much higher. We're going to need to see data that suggests continued inflation, coming down. And there are some flies in the ointment. I mean, this whole Red Sea thing could be a little bit of a fly in the ointment if the weather turns colder, which has been a very warm winter in many parts of the world, and that causes energy demand to come back. If the Red Sea dislocations do cause, container shipping and therefore demand there and therefore pricing there, and for oil, if the ships have to go a longer distance, if all of that reignites inflation, I think in a minor way, not in a major way, but even in a minor way, that's a little bit of a fly in the ointment of the hope that Fed, is going to be cutting rates very soon. And if that happens, I think markets could take a breather.
Okay, Arvind, hi, good morning. I wanted your thoughts on a couple of sectors. One is the PSU banking space, right? There's been a lot of buying action there. In fact, PSUs in general, if we do see a further dip in the market, is it a good opportunity to go ahead and put some more money to work in the PSU space?
Well, typically the PSUs are when everything else has gotten expensive, then people go to the PSUs. So yes, if this is going to keep running, then PSUs are kind of the one of the few areas where you can find value. from us as long-term investors, we're very selective on PSU. Maybe in the power sector, one or two high-quality PSUs. But outside of that, we are somewhat reluctant. And maybe, SBI is the exception in the major banks. But we're not big fans of broad-based PSU basket because we like companies where we can trust the promoters to be interested in return on capital and shareholder value. And PSUs ultimately, let's be honest, are about national service, not about shareholder service. And we're not in the favor of giving money to companies whose objectives are not aligned with shareholders. So yes, maybe as a trade, but as a fundamental long-term bet, we prefer our private companies where management alignment is very clear.
Got it. Hi, Arvind. Good to see you in. But what's the view on the Indian markets, though, for 2024? Things are looking too good to be true, right? Earnings growth is coming about, stable government, crude is not moving up. What's the risk then?
Unfortunately, as we know in life, when things look too good to be true, there's always some nasty surprises possible. I would say 2 or 3 things that could hurt. One would be inflation, not coming down as fast as expected, and all this hot money that is coming in from FIIs, some of that could leave. That's one risk for the Indian market. The other risk is, Indian inflation itself. Is there any risk to that right now? It doesn't seem like it. But, if crude prices start to move higher, if other commodities have a rally, if China shows any signs of life. I mean, this year, one of the best things that happened to India was that China, completely economy was in the doldrums. Nothing stays in the doldrums forever, but if it continues this way, then it's great. But if that comes back to life, that could cause some commodity markets to reignite. So I think those are the risks. But otherwise, from an overall fundamental standpoint in India, I think the fundamental story, other than the softness in FMCG and rural demand, there isn't any fly in the ointment. And I think, with election spending and all of that, hopefully the rural demand will also pick up. So I really don't see any obvious fly in the ointment, but that doesn't mean that there aren't going to be trading risks. So, I think we just talked earlier about whether we'd be buying PSUs. We'd be buying high-quality companies into any pullbacks. And we can be sure there'll be some unforeseen risk factor that comes to play that causes pullback opportunities, and that could present the chance to buy some of those companies.
All right, Arvind, we'll leave it there. Thank you very much for your time. It's a pleasure having you here on CNBC TV18. So that's basically the overall picture. By the way, happy holidays, Arvind, if you don't speak with you soon, again before the end of the year.
Yes, happy holidays, happy new year to all your listeners.
To you, to your family, to your team, everyone as well. Thanks very much for being here on the channel. Well, we'll take a quick commercial break here. A list of top 10 stocks lined up here with our research team up next. Stay with us.
CNBC TV18, embarking on a quarter century of excellence. Azad Engineering Limited, one of the qualified and established supplier, quarter century of excellence.
All right, welcome back. Let's get to our research team now to give us a list of top 10 stocks as we begin the day. And there are plenty to talk about this morning, so let's get straight to it. Vivek is joining in first up to tell us about Siemens and why you should be watching that one. Vivek, over to you.
Well, good morning. Yesterday Siemens held an analyst meet and, highlighted quite a few things. Remember, this particular year has been quite significant for Siemens, given the multiple steps that the company is taking in order for corporate simplification and restructuring as well. So first up, what's actually happened is Siemens India has now become the 4th largest business for the parent globally. Along with that, management has given an update as far as the potential demerger of the energy business is concerned. They have received a proposal, and at this point of time, management will go through the proposal and give their comments back to the parent entity. Now, talking about the business itself, the management has highlighted very strong growth as far as the domestic market is concerned. There has been significant infra spends as well as pickup in private capex, so quite positive read-through over there. Along with that, going forward, they believe long-term growth drivers will be digitalization and industrial decarbonization. Along with that, the company has a digital platform called Siemens Accelerator to accelerate the digitalization in India. Now, an important point as far as the manufacturing sector is concerned, the company has said that they are targeting a transition to from labor arbitrage that they enjoyed earlier in the Indian market to now a productivity arbitrage given the multiple initiatives that they are taking. One concern that markets had was the margins that the company would enjoy in the mobility segment, especially given the large order they got as far as supplying 9,000 horsepower train sets. So in this particular locomotive segment, management has alluded to and has allayed concerns saying that this particular margin business will have strong margins. Along with that, they are saying power transmission segment is seeing significant pickup in capex activity and looking to benefit from local as well as global transmission equipment short supply. Lastly, they've also gone ahead and approved a capex of 416 crore for capacity addition in power transmission as well as vacuum interrupters.
Okay, thanks a lot for that, Vivek. Let's hop across to Mangalam. He's here to tell us about all cargo group companies. Mangalam?
Well, all cargo logistics ended at the high point in yesterday's trading session despite a weak outlook that the company had given in terms of business. So perhaps some part of the street was sussing some corporate development, and that's exactly what has come about. It's a two-step scheme of arrangement that the companies have announced between All Cargo Logistics and the other listed entity, which is All Cargo Gati. Now, what exactly will happen? In step one, the international supply chain business of All Cargo Logistics will be carved out into a separate entity called All Cargo ECU. In that, the shareholding will mirror because everyone will get one share for All Cargo Logistics of All Cargo ECU. The remaining entity, which will have the All Cargo's express and contract logistics business, in that All Cargo Gati will have a merge, for which Gati shareholders will get 63 shares of the resultant All Cargo Logistics company for every 10 shares that they hold in that. And remember, the companies also announced a bonus, so the stock goes X bonus 3:1. So these swap ratios account for all of that. So, if you do a quick back of the envelope calculation, it seems like of the 7,000 crore market cap that Gati, All Cargo Logistics is trading at, 3,000 crores has been attributed to the express logistics division, in which Gati will be a part of, and the other 4,000 crores would be that of international supply chain. This is basis the last close price of both these entities.
All right, Mangalam, thanks very much. Crisp explanation there. Now, let's move on. Abhishek is here. I think the monthly cards data is here. SBI card should be in focus. Abhishek, take it away.
Well, to begin with the credit card data for the industry as a whole, total cards were up 19% YOY and about 1.4% month-on-month. So the momentum with respect to card distribution remains strong. Total spends were up close to 40% YOY and a decline of 10% month-on-month. Now, the decline is seasonal in nature, given the fact that last month you saw festive spends coming up. Average spend per card was up 17.5% YOY and a decline of 11.24% month-on-month. The average spends per card is the second highest ever for the industry. So for SBI cards, the total spends were up about 34.8% YOY and a decline of 11.3% month-on-month. Total cards were up more than 20% YOY and up about 1% month-on-month. Average spend per card 17,237, which was up 12% YOY and a decline of 12.2% month-on-month. So talking about its market share, the spends market share declined sharply to 19.54% versus 19.81% in the previous month, and the cards market share is the lowest that you are seeing in last 9 or 10 months or even more, coming in at 19.01% versus 19.08% in the previous month. Back to you.
All right, thanks a lot for that. Well, let's hop across to Vivek now. He's going to track some stocks that are in the news this morning. Vivek, over to you.
Well, that's right. Quite a few stocks in focus. The first on our list is GMR Airports Infra. Some positive news flow coming in there. National Investment and Infrastructure Trust would be investing close to 675 crore in an SPV that the company has come up with, given the fact that the company will now be developing the Greenfield Airport at Bhogapuram in Andhra Pradesh. The second stock on our radar is WPIL, order win coming in over there. Company has received an order from the Public Health Department in West Bengal. This particular order is for execution of a turnkey project for water supply scheme. The total size of this particular contract is in excess of 425 crore. And lastly, AB Organics, very sharp mover in yesterday's trade. Like we mentioned earlier, Chowatia family has sold close to 12.5% stake in the company via block deals. Some good names coming in there, large funds coming in there, Bofa Securities, Goldman Sachs, ICICI Prudential Mutual Fund, Malabar India Fund, Morgan Stanley and ValueQuest Advisors, all of them picking over 1% stake in the company. Additionally, just prior to market close yesterday, the company also gave an update to the exchanges. They've signed a memorandum of understanding with a global manufacturer of electrolytes, and this is for a strategic collaboration for manufacturing of these cells. So, positive news flow continues as far as AME Organics is concerned.
All right, thanks for that, Vivek. Well, let's wind this down with Upasana, who's joining to tell us about some more stocks that are in the news. Upasana?
Well, first up is LIC. Government grants one-time exemption to achieve 25% minimum public shareholding within a period of 10 years, which is mainly from the date of listing till May 2032. Next up is Brigade Enterprises. Sidwin Cotec Private Limited has signed a lease agreement with Brigade Group to secure 54,300 square feet of Grade A office space at Brigade Deccan Heights, which is in northwest Bangalore. Next up is RailTel Corp. The company has received work order worth 66 crores from NF Railway Construction, which is mainly for supply, installation, commissioning of integrated tunnel communication system, emergency call arrangements in the tunnel at stations in Bairabi Sairang new single line.
Right, thanks a lot for that. Well, here's a quick recap of our top stocks with positive news flow. There's Siemens, All Cargo Logistics, Gatti, GMR Airports, AME Organics, LIC, Brigade Enterprises and RailTel Corp. While the only stock with negative news flow on our radar today is SBI Card. But let's also get a quick handle on what's happening with the brokerages this morning. Sudarshan has poured through all the brokerage notes for us. Sudarshan, what are you looking at?
In brokerages today, we have first Jefferies on Mahanagar Gas. It has a buy rating. Target is rupees 1,350 per share. It says partnerships with auto component makers have started to bear fruit. Higher tie-up of high-pressure, high-temperature gas is compensating for APM shortfall, and electric vehicle risks are manageable. Next one is MS on Bajaj Finance. It has an overweight call. Target is rupees 10,000 per share. It says Securities Appellate Tribunal has quashed SEBI's order on Carvi and lenders to be paid their dues with interest. Bajaj Finance had written off Carvi's exposure of rupees 320 crore in FY20. This will be 2.4% and 1.9% of FY24 and FY25 profit estimates if company receives the amount. Next one is City on 361 WAM, which was earlier known as IFL Wealth Management. It has a buy rating. Target is raised to 750 from 615 per share. It says company is well placed to roll out mid-market strategy by April 2024, and scaling up teams and geographic diversification will aid further. Also, City believes flows likely to remain strong due to market leadership.
Thanks a lot for that, Sudarshan. Well, Manisha Gupta joins us to tell us what all went on with the commodity markets overnight. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, which are surging close to $80 a barrel. The markets are watching out for the Houthi attacks in Red Sea, which are expected to take a 40% cut in sense of oil shipment from there. But not so much oil flows from there, but the street will keep an eye on to developments here, and that is what is adding premium to prices. Good gains is what we've seen in natural gas prices, 6% of gains overnight, and this is after the IEA has reported bigger than expected storage draw at around 87 billion cubic feet here. Also, there are delays in export plans with ExxonMobil, Qatar Energy, Venture Global, which seem to be adding some premium finally as we head towards the year end for the natural gas prices. In metals as a space, it's largely trading within a range. The volumes are expected to decline ahead of the Christmas weekend. But even with that, copper is trading at a 4-month high. You have aluminum trading at a 2-week high, and gold holding around that $2,040 an ounce mark as well. So good going when it comes to metals.
Okay, Manisha, thank you very much for that. So that's basically the commodities back in focus. We'll take a quick commercial break here. We'll come back and we'll get into our discussion. Siddharth Khemka of Motilal Oswal Financial Services with stocks and what's happening in the market, his bets. We'll have the management of V-Mart Retail. Motilal Oswal has written a report titling it Winds of Change. V-Mart has been a big underperformer, although from the recent lows it's come up. So are things turning around for the company? That's the question. Anand Agarwal, CFO of the company, in a bit from now.
CNBC-TV18, embarking on a quarter century of excellence. What a century of excellence.
Welcome back. Hope you're having a good morning as we get into Christmas week. So get done with Friday and then we get into Christmas week. But we have markets to talk about and we just listed all the stocks for you. Let's get some fundamental analysis going. Siddharth Khemka, Head Retail Research at Motilal Oswal, joins us on the show. Hi, Sid. Morning. Thanks so much for joining in. Well, let's talk about the top stock that we just discussed, Siemens. It's had a good run so far. They had an analyst meet. What are you making of it at these levels?
Yeah, very good morning, Nigel, and wishing you, all the CNBC members and the viewers in advance very happy Christmas and New Year. So I think we had a very good update from Siemens. The management highlighted the growth opportunities across segments, plus its plans to demerge the energy division and increase the localization across segments. If you look at what has been happening in the overall capital goods space, is that there has been a good recovery across segments. Mainly driven by the government initiatives towards incremental capex spending, also supported by the private cycle, especially led by the PLI-led schemes that has been leading to higher capex. And if you look at Siemens specifically, they have been benefiting because their exposure towards the core industrials to the government spending side is much higher. Look at the sectors like the railways, the locomotives, where they have then automation is another space where they have very high penetration, and that helps them improve the overall order visibility. So locomotives, metro order inflows have been pretty strong. Apart from that, the recent development that has happened with regards to the parent trying to merge the energy business, that has been taken positively by the market. So we believe that overall that should lead to a value unlocking over the next 2-3 years. And we believe that the company continues to do well. Our estimates currently stands at an revenue CAGR of 16% and a PAT CAGR of 19%. And being a market leader with the best technology in that space, we are positive on the company. We have upgraded our target price marginally to 4,600 and continue to have a buy rating.
All right, that's on Siemens. Siddharth, hi, good morning. I wanted your thoughts on Varun Beverages. After the rally that we've seen, do you think it still makes sense to buy the stock? I'm asking because, both on, when we spoke to Ravikant Jaipuria yesterday, both on Varun Beverages and on Devyani International, there are big expansion plans that the company is looking at in the domestic as well as the international market. So for someone who's bullish on these names, does it make sense to add on?
Yeah, Sonia, I think, first of all, very good morning. So I think we have been very positive on Varun Beverages for quite some time. The company has been delivering the kind of growth the market is expecting. And the recent acquisition that they're doing, plus the penetration in the food segment, these are all leading to the high growth. Right now, we have not baked in the newer acquisition that they have done. So the numbers, based on our past numbers, the valuations definitely look a bit on the higher side. So our target price was about 1,090, around 1,100, which is where the stock price has reached and crossed. So I think we would definitely look to upgrade the target price post the acquisition in the South Africa, which is a very high growth segment and should lead to further re-rating. As you rightly said, stock has moved up. But the core story remains strong. So I would suggest that any dips or declines in the stock should be taken an opportunity to accumulate. We have seen markets correcting on back of a lot of other factors like yesterday. So those are the days when you should look to add on to stocks like a Varun Beverage.
Okay, so that's on Varun Beverages. Got it. The other space I wanted to check with you was the IT stocks, because, we've got some very bullish views coming in from IT names on spaces like generative AI. But before that, also consumption, right? Because there is the festive season going on and there's lots happening in terms of consumption as well. So Siddharth, just stay on. We'll get a quick chat in from the management of V-Mart Retail, and then we'll come back to you for more on that. The stock was buzzing in trade yesterday. It's now up nearly 30% from its 52-week low. Anand Agarwal, the CFO at V-Mart Retail, joins us now to discuss how demand in this festive season is shaping up and the business outlook here onwards. Anand, thanks a lot for joining in, and greetings of the season to you and your team at V-Mart Retail. Tell us a little bit about how business is shaping up currently and what is the expectation as we move into the next couple of quarters.
Yes, good morning, Sonia, and thank you so much. I think business has been going on steadily. We've just gone through the festive period, which was the Diwali and the Puja and the Chhat. So that has gone off quite well. There was a bit of a lull just after that, which is quite usual for all years. But just now, in the last 10-15 days, winter has started to pick up. And winter chill is back in North India, which is good news. And that's resulting in good numbers. So we are seeing good momentum now. Footfalls are also strong. I think I can only say the worst probably is behind us, and we should look at slightly better growth going forward.
Right. Mr. Agarwal, hi, good morning. Prashant here. That's good to hear that probably the worst is behind, because for the last couple of years, compared to what you did before that, things have been a little subpar. So are you saying that phase in a way is behind, and what gives you confidence that that really is so, and from here things will actually in a more sustained way see pickup? And if you can share some numbers, what is your expectation for same-store sales growth, not for this quarter or the next quarter, but I mean, where should you be from here?
No, absolutely. I think what's happened in the last 2-3 years is, one is the impact of the COVID, and then post that the inflationary impact on the mass value customer class. And that saw an impact not only for us, but a lot of other industries, including the FMCG and the rural demand, as well as two-wheelers. And value retail was also not very far behind. So we've seen some bit of a turmoil in the last 2-3 years. But at least in the last 3-6 months, we have seen consumption slowly coming back. The footfalls of smaller ticket size customers now inching back, buying more. Even now, we are seeing a K within a K recovery, even in the lower tier towns and cities. So which means the higher middle class or the middle class is still able to afford more, buy more. And they are more compensating for the loss that we have seen from the lower strata of the income society. So that class of customer has started to come back a little, and that's helping in the numbers. Second thing which has also happened is that in the last 1.5 years, we've done a lot of changes at our end in terms of how we source goods, how we merchandise, how we do up our stores. So there's a lot of rethink and a lot of action which has happened internally in terms of how we improve our operations. And obviously, we've also done 2 acquisitions in the last 2 years. One was in South India called Unlimited, and second was LimeRoad. And there was a lot of spend, in fact, not just monetary wise, but also in terms of the management bandwidth, which went into making sure that these 2 acquisitions went off quite well. So I think in all, if you look at all these 3 things which have happened in the last 2-3 years, we are in a position where we have consolidated and we are moving ahead with full steam.
All right. Hi, Mr. Agarwal. Good morning, and thanks so much for joining in on CNBC-TV18. This is Nigel on this side. Well, since you spoke about those acquisitions, tell us what's the strategy on both of them. On Unlimited, I believe that the profitability is not at optimal levels, and you're looking at closing some stores in all probability. What's the strategy out there? And on LimeRoad, when does it break even?
So on Unlimited, our strategy has been very clear. We've always wanted to get into the South territory, and we rode on the Unlimited platform, and that gave us a very good start. We've had a slightly higher size of these stores in the Unlimited chain from legacy point of view. And in the last 2 years, we have opened roughly around 14-15 stores in South India under the Unlimited brand, but which are more like V-Mart stores. So they are branded Unlimited, but the product and the pricing that we carry is more like V-Mart. And we have had very good success in these new stores. So what we are trying to do is we are trying to replace some of the older stores which were not doing so well with the new format, smaller sized V-Mart stores in the catchments in the tier 2, tier 3 towns, where we feel we have much higher chance of success. And that's what really has been happening. And in the last 2 years, whatever number of stores that we have opened in South India have done significantly well. In fact, they've been doing much better than the legacy Unlimited stores, and they're doing almost at par with the normal V-Mart stores. So the profitability, which had been suboptimal in the unlimited chain so far, I think from next financial year onwards, we should see getting it much closer to the VMart levels. That's the strategy that we have. And we do believe that we will be closing some of the older unlimited stores, but they will be replaced with newer, better stores in the right catchments where we will have much better footfalls.
Okay. Well, there is a lot of competition in this space, right? So Trent, Zudio, for example, they have a digital-first strategy. They have a very competitive pricing point. Reliance's Yousta is doing very well. How is competition, how are you looking at competition right now? And is there any impact that you're facing?
Definitely competition is there and it's always been there. It's not a new phenomena. Definitely now there is a more focus on more organized competition in tier 1 metros and in tier 2 towns as well. I think competition only helps us increase the market size. We are seeing a lot of, increase in the number of people who were earlier not coming to shop in value retail. They are now more aware. All the competition also creates more buzz and it creates more opportunity. In any case, we've been pricing our products slightly lower than most of the competition, and the segment of customer that we target is also slightly different. So while most of the competition targets the youth or the Gen Z segment, we still cater to the the young family and the rural youth or the lower middle class youth for our merchandise and products.
Got it, got it. We'll leave it at that. Thanks a lot for joining in and giving us your views. Well, that's a word coming in from VMart Retail. Siddharth Khemka is still with us. Siddharth, very interesting moves here, right? VMart Retail is actually down 30% this year. It's been a big underperformer. But some of these companies like Trend have been doing very well because of the, fresh brands that they've launched like Zudio. What do you do here? Which are the stocks that you pick?
Yeah, Sonia. So I think very clearly what the management highlighted is what is happening within the overall retail space. Quite clearly, there is a demarcation in terms of the high growth and the focus companies which are doing well both in terms of growth and margins. Revenue, so Q2, what we saw that the aggregate revenue for our coverage of retail companies grew about 14% and mainly driven by footprint additions. We also heard the management about the good recovery that we saw this time around the festive season, and which is where Q3 numbers would be much better and we see improvement. That is where the recovery lies in. Margin profile has remained weak, and that has been a major point of the expectation that things to improve from here. Margins have to overall improve. EBITDA margins for our overall aggregate contracted by 100 basis points. And as I said, a demand pickup in Q3 with stable raw material prices should look at a better H2 in terms of margins. Trends EBITDA margins have somehow outperformed with an improvement of 120 basis points, and that has been supported by strong growth. So I think overall we are expecting demand to be much better in H2 with the festive season already gone by, and we have had commentaries and seen on ground how things have been much better. In terms of our top picks, Trent, Metro Brands and Titan within the overall retail space are our preferred picks. If you look at if I were to include the broader retail, including jewelries as well.
All right, let's do one thing. Let's take a short commercial break on that note. We still have about 15 minutes left for the pre-opening rates to kick in. Mitesh Thakkar and Shrikant Chauhan will join in for some technical trades. Do stay tuned in.
CNBC-TV18, embarking on a quarter century of excellence.
Sir?
On a quarter century of excellence.
Welcome back. There's, 10 minutes to go for the pre-open session. The GIFT Nifty should come up on your screen. Take a quick look at whether things have changed from the first time we looked at it this morning. Not really. So 30 points, 25 points in that range, indicating a slightly higher start. Mitesh is with us, and so is Shrikant, as always on Friday mornings. Gentlemen, good morning. Good to have both of you here. Mitesh, if we can start with you. how do things look? Yesterday, the market recouped a third of day before yesterday's losses. Nifty Bank closed after the last hour rally, closed above the 61.8% retracement of the two-day fall. Looking okay, looking constructive from here.
Morning, Prashant. My sense is that the indices will get into some kind of consolidation. If you look at the charts on different time frames, the medium and the long-term charts look very good, but the immediate, which is the intraday 1 hour, 2 hour charts, there I think it still is showing some signs of profit booking at higher levels, the indicators turning south, which will mean that it will be a slightly choppy kind of consolidation. In that sense, I think the overall idea is that the markets will possibly do a range of about 21,000 in the worst case scenario, 20,900 on the Nifty to about 21,350, or in the best case scenario, 21,550 on the Nifty. So I think it will be about 300-400 point kind of a range. The idea should be to explore more long positions around 21,000 and try to take profits early. You need to be slightly nimble when trading. And once this consolidation is over, then I think there's a stronger chance of us going into a continuation and making higher highs.
Okay, Shrikant Chauhan is also joining in to the discussion. Shrikant, hi, good morning. Looks like the bulls found their mojo back, at least for now. Do you see this up move continue? And what are the stocks that you're looking at this morning?
Yeah, good morning, Surya. Yeah, I think definitely the market, the way it recovered yesterday, we can see furthermore upward activity in the market. But at the same time, the market has opened a very large trading range for traders. So till the markets are not crossing 21,600, we may see upward pullback, but that will limit it up to 21,400 or maybe 350. On the downside, yes, 21,000 is definitely going to act as major support. Until the markets are not breaking back these levels, we are going to see range bound sort of activity. But Bank Nifty, there we saw spectacular interest. The recovery was completely unexpected, the way it recovered from the lows. I think there we can see the levels of 49,000 if we see furthermore performance in the market. So Bank Nifty should be on the watch list. And today, in case if there is any correction, then close to 47,500, 47,600 levels, we should look for adding Bank Nifty to the trading portfolio. Okay. For the stock specific, I think GMR Infra, which was around some 70, 72 levels, from there it recovered back. But there we are seeing further more activity. In fact, it is outperforming stock relatively. And based on overall formation, we are expecting stock to move towards 78 or 80 in the near term. So GMR Infra is a buy at current levels with a stop loss at 70. The other stock which we like is Zomato, which is around 127. There also the stock has crossed its weekly swing highest level. So the next level to watch out for would be somewhere close to 135. It's a buy at current levels with the stop loss at 124. And finally, we like Bank of Baroda from the PSU space.
Okay, all right, got that. Thanks for that, Shrikant. Mitesh, what about you? You've given us your index call, individual stocks as well?
Yeah, I have more of buy calls today. A good breakout happened on Godrej Consumers, made a fresh swing high. So buy here with the stop below 1,059 for a first target of 1,100. AU Bank is something which is showing a lot of strength and outperformance in this market, which is slightly choppy and volatile. That's a buy with a stop at 759 for targets of 795. A conditional buy on Dixon Tech if it starts getting past 65.50. Take a 50-point stop loss from there just below 6,500 and buy for targets of around 66.75. And one sell, that's Bajaj Auto. If it starts breaking below yesterday's low of 6,230, take a short with a stop at 6,300 kind of a stop and look for target below 61.
All right, let's take a quick break on that note. On the other side of the break, the pre-opening rates are going to kick in. We'll also have Rikin Shah of IIFL Securities to put focus on the banks and the NBFC sectors and all the news flow that has transpired in the last couple of days. Do stay tuned in.
CNBC-TV18, embarking on a quarter century of excellence.
Go powered by
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. This is Open Exchange. You're watching us live from the CNBC-TV18 Motilal Oswal studio. We're heading into the market pre-opening rates, but let's also get you some quick comments on what to expect in the market today. Manoj Muralidharan, who's the Vice President Derivatives at Religare Broking, is with us now. Manoj, hi, good morning. Your thoughts on the index? It's seen a bit of a recovery after the slam dunk that we saw on Wednesday, but what is the expectation today and what are the stocks to look at?
Good morning, Sonia. There are two things that we need to understand. First is the quantum of rise we saw from 19,800 and to almost at 550 odd points fall we saw on Wednesday. Now, the second point is there is always a rational when the bank nifty joins the nifty, the trend has got strength, and that is exactly what we believe should be underlined here. Now we are entering into the monthly rollovers from December to Jan, and we believe that if you see even rollover wise 32% to 33 is where the banks have rolled in. Now, this is not really the rollover that we saw yesterday or something, but when the rally started, there was already January position being taken into the Nifty and the Bank Nifty futures. Though the quantum is less, but every time you see that happening, the VWAP, the volume weighted average price action kicks in. So we are expecting that this will be positively biased the next 4 days because Monday is an off and today we might see some option selling in the second half. But till this expiry, which is on the 28th, it would be dictated more from the bank stocks or the bank nifty. And we believe that the nifty would be positively biased, but the lead would be from the banks. So almost 21,600 is where the resistance for the nifty might be and 21,100 as a support. So we're expecting that 500 odd points. For the bank nifty, the ratio is almost at 2.24, which says that, there is more like a possible 13 to 1,500 more points. So somewhere close to 49,000 is what we're expecting. Usually when this happens, Sonia, even we are expecting the first week of Jan, the Nifty might touch that 22,000 plus or minus 200 odd points, and that is where the consolidation might start. We look into concepts like cost of carry and some quant models, so which suggests that as of now, we have a 700 odd points before we should start worrying, at least on the Nifty side. Stock specific, because of rollovers, we look into cash positioning also with the fresh arbitrage that goes on in the stock. So Tata Motors tops the list. Let's say 710 is where you can buy that, 695 as a stop loss and a target of 740 on that. Godrej CP at 1070 also becomes a buy for a target of 1120, a stop loss of 1045. We like Bandhan Bank at 238, the stop loss should be 232 and we expect close to 248 to 49 on that. And Federal Bank has a target of 162 with a stop loss of around 146 on the stock.
We'll leave it there. Thanks very much. Enjoy your Christmas weekend and we'll speak again, Manoj. Thank you very much for being here on CNBC-TV18. Well, let's focus on the financial space now. RBI has tightened, AIF investing rules for banks and NBFCs to essentially prevent the risk of evergreening of loans. Rikin Shah is Vice President at IIFL Securities. He's joining us now to talk about this. By the way, yesterday we had clarifications from companies like Piramal, IIFL, etc. coming through. How big of an issue is this, Rikin? And will we hear more NBFCs coming out with their respective exposure and what they plan to do about it?
Okay, so thanks for having me on the show today. So in terms of the exposures of the banks and NBFCs, we have highlighted that the NBFCs are primarily the ones who are using this conduit to evergreen some of the loans. We had quantified the exposure of select NBFCs like Piramal, Edelweiss, Indiabull Housing Finance, IIFL Finance as well. Now within that, the impact of this ranges anywhere between 10 to 20% of the net worth of the select NBFCs that we spoke about. Banks have a much lower impact that would probably be in the range of low to mid single digit. Now Piramal has put out a release as well as IIFL Finance has. Our sense is that there are going to be multiple second order impacts of this as well. Beyond the impact on the lenders where they will be forced to take some provisioning, we see 3-4 impacts as well. Firstly, there will be redemptions of the AIFs being done by the banks and NBFCs. This means that today in India, the AIF size is around $40 billion. That includes many other VC, PEs, etc. as well. But as the redemptions come in, there will be mark-to-market losses for not only the banks and NBFCs, but other guys also who are invested into the AIFs. So that's point number one.
1 minute. Why will there be redemptions caused by? By the NBFCs, etc.
Because by the regulation, the RBI says
you
that
have to unwind.
You have to unwind within 30 days.
Right.
If you don't unwind in 30 days, you have to take the entire provisioning of those investments in your P&L.
Correct.
So there are only two options. So now if there are going to be unwinding, that is where there can be mark-to-market losses on the NAV for the holders of this AIF investments. So that's point number one. Point number two, with this regulation, the entire investable universe for the AIF also goes down because they cannot have an overlap in terms of the same borrower exposure as the bank and what they would invest in. Thirdly, in addition to the mark-to-market losses that we spoke about, we are also going to closely monitor some of the stressed accounts which were not recognized as NPAs until now could probably slip into NPAs in the coming quarters. Because this conduit has been now fixed, the loophole has gone, and that is why some of these accounts can slip into NPAs.
Okay, Rikin, hi, good morning. Thanks for being here with us in the studio. I wonder your thoughts overall on the financial space. Now, PSU banks have been doing very well, but your preference is private over PSUs even now. Why is that the case, and what are your top picks in the space now?
So here what we are saying is that the private banks have significantly underperformed in the last couple of years due to certain idiosyncratic factors and investor positioning. We see that changing now. The merger of HDFC is behind us, the management change at the Kotak is also behind us, and the Axis acquisition of Citi portfolio is also behind. So with all of those idiosyncratic factors coming to an end and the underperformance that we have seen, going into the next year, the reason why we prefer private over PSU banks is on account of three things. First, as the asset quality environment starts normalizing, we expect higher increase in the credit cost for PSUs versus private banks. Second, in terms of the capital raise impact for PSU, we already saw RBI tightening multiple regulations in last 1 month. That, coupled with the potential ECL regulations next year, means that the PSUs will need to raise more capital to fund their growth. And thirdly, unlike 2 years ago, the risk reward is no longer as favorable as it was in the case of PSU. So we have a preference for private banks. Within the private space, we like Axis Bank, HDFC Bank and IndusInd, and relatively a bit more cautious on Kotak.
Okay, all right. So we've got those picks in there again. But what about from the PSU basket? If you had to pick one, would you stick to the larger banks? Because some of these have already seen some bit of re-rating.
Sure. So we would stick with the larger names like SBI at this moment if one has to really invest into the PSU banks. But in the entire overall spectrum of things, we would still prefer private and some select NBFCs which can also be a beneficiary next year from the rate cut cycle.
Right. Rikin, sorry, just to go back to what we began with, which is the AIF thing, the third order impact that you said, right, which is that some accounts may slip into NPAs. Have you been able to, you would have a broad sense, right, which are the tricky accounts in that sense, and which are the impacted NBFCs, I mean, potentially impacted NBFCs? What's, yeah, go on.
So this will mainly be the accounts which used to be evergreen were largely in the real estate space.
Okay.
So we could see some of the potential names coming from them. Won't have the specific names here, but these are some accounts which can slip. In terms of the NBFCs who could see some impact, it would be the same guys who have higher exposure to AIF as well. Having said that, even the banks who lend to the similar kind of borrowers may also see some impact. However, on a relative basis, the impact may not be as big for banks, but even banks might be able to see some downgrades of the real estate developer accounts as well.
For companies, for NBFCs, which have a disclosed exposure, and you're saying that more perhaps will do so, have you changed your earnings expectations, and have you lowered your estimates for these NBFCs?
So the names that are going to be largely impacted are the ones which we don't cover as yet, but it suffices to say that we would see earnings cut primarily to the tune of the 10 to 12% that we have been talking for some of the NBFCs.
Okay.
And do you, just one more thing, we saw this regulation coming in for RBI earlier with the risk weights going up, right? Should we expect more? I mean, is this, and what are the investment implications we head into? We talk about PSU versus private banks, but also there was this case building up for NBFCs to do very well into 2024. Should one pull back that expectation a little bit as well and stick with large banks in that sense?
So the way RBI has reacted in last few months is not specifically targeting only NBFCs, but they have done a very decent job in terms of preempting where the potential risk could be in the system down the road. So even for the personal loan tightening, we have highlighted that on a top-down basis, there was no exuberance. But the scorching pace of growth by some of the NBFCs within short span of time was creating a problem. And that is where our assessment was that fintechs and some of the NBFCs who originate these loans via fintech would be primarily impacted. Even this regulation today, most of the evergreening which used to happen over a period of time has subsided given the real estate cycle in India also has revived. So the way I think about this is that RBI has been acting preemptively to curb some of the risk in its bud.
All right, we'll let you go on that note. We've run out of time, but thanks a lot for joining in, and thank you for explaining to us this entire issue and how to approach banks. By the way, the pre-opening rates have settled quiet with a gain of almost about 40 odd points, so looking pretty good over there. Led by Adani Ports, LTI, Mindtree, Tata Motors, all the top gainers at the moment. But let's find out what the standout brokerage report is of the day. Nimesh is here to give us details on that. Nimesh, over to you.
Hi, morning, Sonia. So today's standout is in logistics sector. UBS has put out a note and they've initiated coverage on 3 names within that space. The first name is Delivery. They have a buy rating there. On Adani Ports, they have a neutral rating. And on Concor, interestingly, they have a sell rating. So these are the 3 names that they're initiating coverage on. On Delivery, I'll start with Delivery first. They have a buy rating with a target price of 550. They believe that consolidation, inflection on parcel growth and spot-on integration. These are the key triggers for the stock to do well. They're bullish on three specific reasons. 1, long-term growth. 2, strong profitability potential. And 3, a strong moat and competitive leadership. They've highlighted few challenges as well, including competition and ownership with some investors. On Adani Port, they have a neutral rating with a target price of 1174. They believe that they see limited upside from here after the sharp run-up in the stock price and the fact that they expect a modest sector growth. While Adani Ports may do well, the sector may see a very modest growth. And on valuations, the stock is now trading at close to 15 times 1 year forward EV/EBITDA versus historical 14.5 times. So valuation is also fully priced in. On Concor, they have an interesting sell rating with a target price of 770. They are cautioned because of the market share loss, high valuations, and the EXIM growth, which is slowing down. So EXIM segment contributes nearly 70% of companies' EBIT, and that's weakening. So that's a key concern for them. And even in terms of valuation, stock is now trading at 21 times 1 year forward versus historical 18.5 times. So that's the three stocks: a buy on Delivery, a neutral on Adani Ports, and a sell rating on Concor from UBS.
Okay, all right, Nimesh, thanks very much for that. So those are 2 calls, Adani Ports and Container Corporation. What's the momentumizer stock of the day? Mangalam is here with that. Mangalam, morning.
Well, the momentumizer stock of the day has to be Greenply Industries. Why is that? Because yesterday the stock moved around 5.5%. This week has been a decent one for them. It's a 15% up move that we've seen on the counter this month, about 20%. And this year, it's a 63% up move that we've seen. With this, the stock is now just about 5% away from a 52-week high. And delivery volumes this week have been extremely high. On day 1 of the week, it was 5 lakh shares. On Tuesday, it was close to around 12 lakh shares. Yesterday as well, close to 4. And the previous day was 6 lakh shares as well. And this compares with a 3-month daily average delivery volume of just a little over 2.5 lakh shares itself. So the stock's moving higher, delivery volumes are picking up. The question is, what are the triggers? Well, there is usually better demand in the second half of the year for building products and also ahead of election years. MDF business of the company, which saw its first full quarter in the second quarter, will now start to contribute further to their overall business, and as a result of which there would be further margin improvement too. And remember, the last quarter was also marred by some supply side issues in Gabon, which the company believes will recede by the end of this year. So if that happens, that would be one positive figure too.
Got it. Thanks a lot for that. Well, let's get some 9-10 calls going as well. Mitesh is back with us. Mitesh, what are you looking at 9-10 this morning?
I'll go with a buy on Godrej Consumer with a stop below 1059 and a first target of 11.
Okay, that's a buy on Godrej Consumer. But one stock that refuses to get out of the news is Zomato. It's been one of the big movers this year, and Mangalam continues to track that. Mangalam, what are you looking at today?
Well, it's been a big mover and there's always news around it. But yesterday there was, much ado about nothing, largely because post-market close there were reports that the company is going ahead and buying the entire business of Shiprocket for about $2 billion. And just before market opens today, and yes, last night we got a tweet from DP Goyal saying that they're actually not looking at acquiring Shiprocket. In fact, they're only looking to focus on their core business and not looking at any acquisitions in the near term. So that's a positive, the fact that they're focusing on their core, because the core isn't doing too badly. In fact, the company will see a ramp up in their food delivery business and the quick commerce business, which is Blinkit. And Jefferies has written on it. They have a target of 165 rupees per share. They say that Zomato already owns 5% stake in Shiprocket following an investment in 2021. And they ascribe a low probability of any deal at this stage itself. And the margins in their food delivery is key. Plus, it's the last week of the year where we see a lot of people ordering a lot of food. So Zomato is typically in focus as we move towards the New Year's.
Okay, all right, Mangalam, thanks a lot for that. Well, let's go across to Vivek. He's joining us to refresh about Siemens. Vivek?
Well, that's right. Post the analyst meet yesterday, we highlighted the key takeaways. Brokerages too have reacted after they have met the management. So what UBS has to say is, they've maintained their neutral stance on the stock, target price at 3,750. They're saying in this current phase, the leadership team has managed the earnings volatility much better versus the past phases. Now, what they're saying is that earnings growth is important. Order intake momentum is actually much more important as far as the valuations driver is concerned. Jefferies, come back a lot more enthused. They maintain the buy stance. They've raised the target price to 5,000 rupees from 4,520 that they had earlier. They believe that Siemens is a good play on power transmission and railways. CLSA, while they do not have a rating on the stock, one key point that they mentioned is that it's a clear case of make in India for India as well as the world. Now, almost 15% of the total revenues of the Indian listed entity comes in from the exports. And lastly, Motilal Oswal, while they maintain a buy stance on the stock, they do say that near-term order flows may be affected by the general election schedule. However, long-term prospects remain very strong from transmission, railway, data centers, as well as industrial automation businesses.
All right, thanks a lot for that. So we have a lot of stocks that are in focus this morning, and looks like it's going to be a good, positive morning of trade. Just wanted to get all cargo logistics. We, of course, covered that in pre-opening as well. But the fact that they will be demerging their international supply chain business into a separate entity now, all cargo ECU, it's got the stock. Look at that. All cargo Gati is up almost about 6% as we speak. So just keep an eye out on some of these logistics stocks. Of course, there are brokerage notes that are positive on the logistics space as well. Plenty of other stocks to look at this morning. Overall for the market, looks like it's going to be a decent start. 21,200 is something that the street will hold for now, and led by a lot of heavyweight names. So just look at the top gainers in trade at the moment. In pre-opening, there are IT stocks. LTI Mindtree is up 1.5%. Tech Mahindra is up about 1%. Autos are coming back. Bajaj Auto is up almost about 0.6%. And in the broader markets, plenty of other stocks to watch. We are, of course, heading into a long weekend, so there won't be any cues from the US markets on Monday, and our own markets will also be shut. So trade, the volumes, etc., might be on the lower side. But other than that, individually, there is lots to talk about. Many order wins that have come through as well. Railtel, one of the stocks in focus there. But let's take it straight to the first tick on the index. 50 points higher on the Nifty, a good start there. The sensex is up about 100 odd points. The mid-cap index is open to a strong showing as well, 250 points higher. The bank Nifty for now is refusing to participate, but let's see early moments yet of the day. The advance decline ratio has almost 2,000 stocks on the advancing side. So it's looking like a decent screen at the moment. What's leading from the front is some of these power stocks. NTPC is up about 1%. Then you have LTI, Mindtree, Eicher Motors, Adani Ports, Hindalco, ONGC, HCL Tech, that are your big gainers. By big, I mean like about 0.5% to 1% gain at the max. Bank Nifty is the one that's dragging its feet a bit. ICICI Bank, HDFC Bank, SBI, Kotak Mahindra Bank, flat with a bit of a negative bias. So that's just the little bit of dampener this morning, and that's making sure that the Nifty doesn't get above the 21,300 mark. So flat opening, you'd have to say, with a bit of a positive bias, led lower by the bank Nifty, which is dragging its feet. Infosys is also your top loser at the moment, down about 0.6%. But other than that, the mid-cap index is having a good showing.
Well, that's right. So I think at around 21,300, if getting into a long weekend, you want to enjoy Christmas, maybe taking some money off the table at around that 21,300 may not have been such a bad idea. As we speak, the markets have come off that level. We're only holding with a gain of around 10 points. Let's run it through the stocks that are moving around. The all-cargo stocks, logistics as well as Gati, owing to that scheme that has been announced overnight. Both of them are between 7 to around 9%. Remember, they went into this event at the high point of the day, but clearly the street likes it because there is follow-through buying that we're seeing out there. AMI Organics, yesterday we had a large trade that took place. Then they announced some progress with regard to that electrolyzer as well later in the session. So that stock, in fact, from yesterday's block trade is up closer to around 15%. Nimesh was the first one to alert us with regard to that block deal. So that's out of the way. The stock is flying away. The other couple of big movers today, you have Realtel, they won that small order in there, but the street likes it. The stock up closer to 2.5%. LIC, they'll get more time to meet those minimum, shareholding norms. So that's why that stock is well up closer around 7% as we speak. I think that's at a multi-month high. So that stock doing pretty well as well. On the flip side, I think just a few stocks to highlight that are on the downside. You have Nippon Life India, well, that's a little bit under the weather, and Polycab pulling back a little bit. Siemens posts their analyst meet and brokerage notes. Street likes it, up close to 3%, and GMR Airports continues its northward move to 2.5% higher out there.
LIC guys, right?
Yeah,
LIC
flying.
is 7% higher, so that's a big one. And it's, by the way, the top volume traded gainer across the board. So there's a very, very large move. What else, apart from what we've kind of highlighted? I think all cargo is another one. Mangalam, of course, discussed this earlier in some detail, 8% on that one. There's a Siemens analyst meet. Ami Organics, Nimesh has been highlighting for the last, actually since yesterday. There is RailTel, which is up 3.5%. Pull up Cyient. Cyient is up 4%. By the way, the management joins us in a bit from now. So almost 2,400 on Cyient. Adani Total Gas is up about 3%. Stocks at about 1,012, 1,013 for now. There is Piramal Pharma, which is up about 2.75%. The wealth management company, the IIFL Group, 361. So that's 3% higher coming through. RateGain saw a very sharp move in the last hour yesterday, ended 7% higher, and RateGain is up another 4%. I think we had the management with us. It was yesterday or the day before, but that is flying as well. There is V-Guard, which is up about 4%. Inox Wind is up about 3.5%. Keynes Technology is up about 3.5%. All of these diagnostic companies had started on the front foot yesterday. I can spot Thyrocare, which is up about 4% as well. Market breadth is overwhelmingly in favor of gainers. So there's nothing at all which is down, except Varun Beverages, which is pulling back a little bit after what we've seen. Varun Beverages is down 4%. 1,243 is where we are coming in at. Well, our market master of the day is Sandeep Bhatia, head of equity, India and country head in India at Macquarie Group. Sandeep, great to have you back on the program. Thank you very much. Almost wrapped up with 2023. If I can start, before asking you, what the future looks like, but if I can ask you to reminisce a little bit, what were the, say, top 2 or 3 surprises from what you thought when you came into this year and how it actually panned out?
So first, wishing all of you and the viewers a Merry Christmas season and a great New Year. All our offices in Christmas colors, and so am I. So the biggest surprise as we look back on 2024, I think twofold. One is what happened in the US. The recession never happened. And the rate cycle has peaked much faster than most people thought, without doing any significant damage to the US economy. The only political uncertainty that remains is the 2024 elections. And the surprise here is that most of the time people talk about Indian elections throwing a negative surprise. But this time around, it seems that people are worried that the US election may throw a negative surprise. So clearly, how tables have turned and how life changes. So clearly, political uncertainty and disputed election results may be a risk for the US. It doesn't seem to be a risk for the Indian elections. As far as surprises in India are concerned.
Sure, go ahead, please.
I think it's a positive surprise, better than most people would have thought at the beginning of the year, is the continued strength in the economy and the fund flow from domestic savers into stocks. Despite some bouts of corrections, the retail investor and the SIPs, the systematic investment plans, continue to get inflows. So these are the two things which I wanted to flag as I look back on 2024.
Okay, well, look at the Varun Beverages stock, by the way. It's down almost about 3.5%. It's had a dream run in the last 1 year or so, and just some profit taking is what we're seeing. Sandeep, as we head into the new year, what are your preferences in terms of sectors? Any themes, sectors that you're bullish on, where there could be alpha generation this year?
I think clearly there has to be now sector rotation on the back of what I think would be a stronger reform push post-July, when the new government will be able to present its full budget. The Feb budget will be a vote on account, as the finance minister has already discussed and told us. So I think the expectations are for a broader industrial, manufacturing and consumption push. I'll say consumption also because in the run-up to election, generally there's an increase in spend. Also the fact that India is seeing very strong revenue growth, and one of the best ways to grow consumption is probably to also do a lot of welfare spend. I think that this government will also continue its welfare spend and boost the rural economy. So I think in the run-up to the election, one has to look at if there's a rural rebound, and post the July budget, if there is a trust on broader consumption and broader investment growth. CapEx rebound from the private sector has been slow. That's one thing which I'll wait for to see if that comes through in the second half of next year.
Hi Sandeep, morning and good to see you in, and compliments of the season to you as well as your team as well. I think when we spoke a couple of months or so ago, you were hinting that maybe the Ferris space could do quite well, and that's where alpha could be generated, if I remember correctly. And I'm looking at the Chinese data out there, and it appears it's still to pick up. But the good news is spreads over there are at very depressed levels. So things maybe can only improve from here. Do you think that 2024 we could see some of these steel stocks outperform?
The steel stocks will outperform if control of supply in China can continue. So that kind of supply control and production control, if China can successfully put in place, and also the broader, what is called this, the broader emerging markets, the poorer parts of the world, see a stronger growth coming through, then consumption of steel can come through. But it's entirely dependent on what happens in China and what kind of control is exercised by the Chinese government. Our understanding is that China wants a revival. It's trying its best to revive consumption, shift its entire economy, which was a very production-driven, manufacturing-driven economy, to consumption. But there are headwinds, especially in terms of consumer confidence there, especially in terms of the entire property sector. So if that happens, if they are able to exercise control on production, we will see a rebound in the ferrous side.
Okay, I got it. When one kind of looks through, Sandeep, are there real underperformers? I mean, actually, even as we came into 2023, there were those pockets, right? Maybe power had not done as well. IT services, maybe, especially on the mid-cap side, etc. As we head into 24, are there really sharp, areas where which have not performed? I mean, which gives you that comfort. Maybe chemicals is one, but that's a very small space. What's your sense? I mean, you basically got to buy stuff which is already done very well.
I think that's a fantastic question. What do you buy? Because everything is expensive, everything is done well. And do we just continue to ride the PE expansion and price appreciation graph, or we wait to see there is a major correction? I'm not in the camp that in the short term, which is the run-up to the elections, we can see a major correction. By a major correction, I would think a 10+%. So ideally, a 15% correction would be would classify at least as a major correction. Anything over 10%. But as we've seen just 2 days ago, any sharp correction is actually sees quick buying come through. So unfortunately, I think for investors, it's a market with expensive pickings. I would think, therefore, the right strategy would be to position yourself in sectors which are sort of underperformers. So as I said, consumption can be the dark horse for next year, because there are some very high quality companies and everyone thinks that consumption is going to continue to remain weak. But if you take a 2-year time frame, we could have a better outlook on consumption come through. The other, of course, is the entire public sector enterprises. So that will be one sector which generally is cheaper. And in that, I think public sector banks are large, liquid. And the cycle that we are seeing, we have seen RBI do the right moves. They have tightened risk weight assets. They're trying to control the consumer lending, that's happening. And if we see corporate lending and infrastructure lending come through in the second half of this year, public sector banks are well positioned to take advantage of that. So I think these are the two parts of the stock market which have broadly been underperformers or cheaper. Take your pick, and you could look at them performing.
Okay. There are a lot of big events that are coming up in the new year, right? There is, of course, the elections. What are the spaces that you think could benefit from that? There will be a pickup in infrastructure spends, I'm sure. A lot of infrastructure stocks have been doing well so far. What else? Where else do you see the opportunities because of these large events upon us?
I think the common knowledge is that there is more government spending in the run-up to the elections. Actually, we have not seen that happen in a remarkable way pre-elections, at least in the last 2 elections per se, and the government broadly seems to be on track to meet all its fiscal targets. I think what is important is to actually acknowledge that one of the key reasons why the continued success of the current government is the effectiveness of delivery of subsidies. And I think all that can continue post-elections, more likely than pre-elections. But broader consumption revival is the theme which I've talked about in this interview, and I would think that I'll monitor that in the run-up to the elections.
Okay, broader consumption revival, got it. Thanks a lot, Sandeep, for joining in. Appreciate your thoughts here on CNBC TV18. And once again, from our entire team to yours, thank you for being with us through the year and all the best for a great 2024.
Thank you.
All right, let's move on now. Let's focus on IGL. The company has completed 25 years of its incorporation, and in these 25 years, it has grown to be one of the largest CNG distribution companies of India. Kamal Kishore Chatiwal, who is the managing director at Indraprastha Gas, joins us now to discuss how the journey has been so far and what's next for them here onwards. Kamal, thanks a lot for joining in. Of course, we tend to look back at the journey of the last 25 years, but I think your shareholders would want to know what do the next 20 years look like for the company, right? So tell us about the big growth triggers that you see and where do you see the big opportunities for IGL?
First of all, a very good morning to all your viewers. And I would also like to congratulate CNBC for completing 25 years.
Thank you.
I understand you are also in the 25th year, and it has, we have grown up, or rather seen your growth throughout these 25 years. And the way you have revolutionized the business reporting space. So we have done the same in the CGD space. That wherever you find that name of CGD or anything to do with CGD, so IGL is up above there. So having said that, in the last 25 years, the way we have grown the infrastructure and proof of concept, starting from a proof of concept phase in 97, 98 to today, where the model of Delhi and NCR is shown everywhere. In the regulators' government, they are proud of our achievement. IGL's achievement, and that is being showcased as a case, a big business case for CGDs around the country, not only, also in the world also, that is being shown. That the way we have succeeded in Delhi, I'm sure since we have gone out of Delhi now, we will continue to do that. Okay. As far as the shareholders are concerned, the way we see the future, so one of the sectors which is in the prime right now and which can propel the growth of, or rather I should say, the share of...
I can't hear him.
Oopsie, I think...
sectors...
Yes, sir, go ahead. Go ahead. We lost you for a bit, but you're back with us, please.
Yeah, I think just like the fertilizer, there's stagnation there as far as the natural gas growth is concerned. Power is struggling to use this gas. So only sector that we see which can take India from 6% to 15% is the CGD sector, where we see tremendous possibilities in the sense that now that after the 12th round of bidding, almost 100% India would be covered through allocation of geographical areas. So in that sense, and if you see the last 5 years growth, so from 1,400 odd stations to now more than 6,000 stations. So huge growth has been there. And the way the conversions are taking place in NCR, I can speak of Delhi, NCR, Noida, because here the commute is slightly more. So what we see is that around 25% growth in CNG, and when we were talking to Siam representative, And he informed us that the growth in CNG sector, as far as the vehicles is concerned, is around 45%. Whereas the other sectors are the petrol versions are growing at 6 to 7%, but CNG segment is growing at 45%. In NCR, we see the conversions also at more than 16, 17,000 per month. So that's the number we are seeing. So we are confident. So one is that we continue to grow the infrastructure that we have created, not only in Delhi NCR, but outside Delhi NCR. And once the sector consolidates, so there will be more such opportunities because companies like IGL and bigger companies like IGL, they can accelerate the pace of development of infrastructure.
Yes. Got it. All right.
Good
morning, sir. Yes. Good morning, sir. And, good to grow up together. As you said, 25 years hand in hand. It's been a good journey for both of us. And, you have broadly stated, how do you see things shaping up? Let's talk about the near term, though. FY24, you all were guiding that you'll hit an exit run rate of close to around 9 MMS CMD. Are you on course for that? Point number one. And also your industrial PNG volumes for the past month, that is in November, I think there was some kind of softness over there. How are things shaping up post that?
So first is that we are confident of closing at around 9 million per day because, the station commission planned during the year, they get commissioned mostly in the third and fourth quarter. So as our stations get commissioned, because recently 4-5 stations we have commissioned recently, so those volumes will come up. We are confident of exiting the year at around 9. And as far as the second question is concerned, the industrial segment, yes, there was some price disadvantage, I would say, and you are aware that that is because of the taxation, because it is not in GST, so pass-through is not there. But we are recalibrating our pricing strategy around industrials. So with that, we plan to make it more competitive so that there are more. One of the positives that has come up in NCR has been the mandate of CAQM, where they have mandated even the DG sets used by individuals, other than the commercial, they are also being converted. So there we are seeing a huge growth. In addition to that, all the industrial clusters around Delhi NCR, say 150-kilometer radius of Delhi NCR, so that have been converted, that have been connected rather by IGL. So we were given a mandate of around 125, 130 industrial clusters. So we have completed that. So once people start, and there is a growing awareness about this fuel, so people, once they start converting, we are confident that this industry.
Right. I think, right. Mr. Kishore, thanks for that. Good morning. Prashant here. I have two questions, sir. One is just to kind of take off from what you said. I think the situation in terms of global gas prices, etc., was pretty different a year ago, a year and a half ago. Now they're much more well-behaved. The winter in Western world, but I don't think we're seeing any sharp spikes, except the fact that recently, because of this Red Sea issue, we've seen some spikes come through. So I just want a quick sense of that. I mean, is that likely to impact, how is that likely to play out for you? That is one. And second, if you can talk to us about if you have any more clarity on the Delhi EV policy and the impact. Because last time, you'd said that the impact could be about in the range of 3 to 4% of volumes. Do you have a better sense now? Go on, sir.
Yes, sir. We have a better sense. Yes, you're right. The prices are more or less stable now. The spot prices are in the range of $11, $12 per MMBTU as of now. There was some impact of Red Sea. There was more on the crude side. And gas was slightly less impacted by that. Secondly, as far as the EV is concerned, we see that the reaction was, in my opinion, overstated. I mean, we had a very conversion rate. The way the people are converting to CNG is still robust, and only the DTC volumes we see that they are going down. But again, some of the volumes have gone up, and we have been able to not only maintain but increase our volumes in that. So we feel that going forward, there will be a space for CNG also in addition to EV. Because that is the natural transition we see, that once you have diesel, then you have a transition fuel, natural gas, and then you have the electric.
Correct. Can I ask you to specify, sir? Last time you had said the impact could be 3 to 4% of volumes. Will it be less than that now?
I think that with the increase in the passenger vehicle segment and other segments, the commercial segment, the impact could be even less than that.
Less than
we are increasing the volumes.
Yeah.
The way we see that every month our volumes are increasing.
Okay. In Delhi, I wanted to understand, Delhi is also focused on some other transportation segments for going electric, right? What can this mean for sales to, say, the buses segments, autos, personal four-wheelers, etc.?
You see, bus segment is 6 to 7% is DTC. So that we have factored in that going forward in another, say, 2 to 3 years, 4 years. So that is going to be electric. Because the way the pollution situation in Delhi, we see that playing out. But we are increasing our infrastructure in Delhi NCR region because we still see huge queues. And that is one of the factors that is deterring people from converting to CNG. So that problem, that issue, we will be going to address in the near term of 1 or 2 years.
So when you say increasing your infrastructure, can you just give us some details? What does this mean in terms of expansion plans? And is it only Delhi, or is there some other geographic expansion that you're looking at as well?
So Delhi NCR continues to grow and we will continue to expand there. In addition to that, all the other GAs in UP, Rajasthan, Haryana, whatever we have, we are expanding the infrastructure also there. So that right now the perception about CNG is that there are huge queues and those issues are there. But at least in other GAs where we have land easily available and we can develop infrastructure fast, there we want to showcase that, you can easily go to any station and get it filled. So that will, I think, increase the conversion.
Right. And your capex plan that you had laid out, I think, was 1,500 crores, right? So no pullback out there.
No pullback out there. In fact, one of the other segments that we are looking at is the LNG segment. Right now, one of the challenge in using LNG in northern India, I feel, is that the transportation cost, because only either you take it from Dahej, Hazira or Dhamra, wherever you take it, is more than 200 to 300 kilometers. So transporting LNG through that distance requires a huge cost. So we have a thought that in case we can liquefy LNG lower than the transportation cost and below $3 per MMBTU, then that makes a business case for use of LNG in the commercial and heavy duty segment. In fact, we are setting up 3 to 4 LNG stations along the Golden Quadrilateral immediately. And going forward, that continues to be one of the areas that we'll be working on.
Okay, all right. So that's another opportunity. I think a couple of brokerages have mentioned as well about that LNG opportunity. But the capex number, just to reconfirm, 1,400 crores, right, is what you've laid out?
14 to 1,500 crores would be there.
14 to
because in case
1,500.
the LNG pilots also come on stream and 2-3 projects of LNG are
Got
there.
it. So let's get a couple of more numbers, sir, since we have you with us. X of cab aggregators, your volume growth you had guided for FY25 was around 8-9%. You stick by that?
Yes, we stick by that. 9 to 10% growth will be there.
Okay. And finally, the EBITDA per unit, you've been in the vicinity of around 8.5 odd. You can hold on to that?
Yes. Yeah, above 8 is our target. So we'll be continuing to maintain above 8.
Above 8.
Recently, there was some, as you know, the APM allocation has gone down by 17%. But we are confident of maintaining 8 because we are bringing in some operational efficiencies. So with that, we will be able to maintain it.
Well, it's been a pleasure talking to you, sir. Thanks so much for joining in on CNBC-TV18. Congratulations on the last 25 years and wishing you all the best, you and your team, for the next 25 years as well. And thanks for being a friend for the last 25 years.
Thank you. And on behalf of entire IGL team, I also wish you a very happy, or rather I would say you have completed the silver phase and now you'll be entering the golden phase of your journey.
Lovely. And Happy New Year, sir, to you. Thanks so much for that. Well, for the time being, though, we'll have to slip into a short break. When you come back, we'll get to our special offering, Big Winners of 2023. We'll connect with the management of Maharashtra Seamless. You stay with us.
CNBC TV18, embarking on a quarter century of excellence.